Hello from New Zealand. My name is John Gallagher, a professional economist with a particular passion for foreign exchange. I'm going to speak for about 10 minutes or so on how I see the current global position and outlook. My talk is split into two parts. The first part covers what are the main current themes behind foreign exchange rates. And the second is what are the outcomes of those themes. First of all, the themes, I'm counting 4 themes. And then when it comes to outcomes, I'm talking 5 broad outcomes. First of all, themes. The themes are globalization, global financial crisis, oil prices, and free trade. First of all, globalization will be familiar to all of you, but let's just remind ourselves about the pace and scale of the opening up of economies in the last 20 to 30 years. There's a tremendous momentum, tremendous scale, and we have benefited as a planet, benefited as individual countries in promoting world trade and enjoying world trade. Second theme, the global financial crisis began in 2008, and so many countries were challenged, very severely challenged, by the outcome of the global financial crisis. Fortunately, in the developing world, economic growth rates were maintained at a high level, and this allowed the export side of developed economies, countries, to continue on growing. So there was, if you like, a safety belt for developed countries. They still had to adjust to the negative consequences of the global financial crisis, but that adjustment was much less severe than it might have been. Third, oil prices. Oil prices have been the major cause of global recessions since 1960s. Mainly because of volatility, political volatility and economic volatility in the Middle East. We have seen episodes where oil prices even quadrupled within a short period in 1972. But since then, and even recently, the last 10 to 20 years, we have seen new technologies become available, which allows that volatility in oil prices to be held more in control. The fourth and last theme I'd like to introduce is trade, world trade. Now, the outcomes, I'm going to assume, because we only have 10 minutes, that each of those 4 themes that I've mentioned has been studied by you, that you have a fair grasp of the effects of those 4 items. So I'll concentrate now on the 5 outcomes in particular for foreign exchange markets and global and regional and country economic policies. I've used 1, 2, 3, 4 in the first, so I'm trying to use A, B, C, D, E, F for the 5, A, B, C, D, E for the 5 outcomes. First and most important, the world has huge spare capacity to produce. Levels of unemployment may seem low in some countries, but in many countries, unemployment remains very high. Underemployment, low real wages, low investment, even with low interest rates, means that we have tremendous capacity still within the global economy to produce and have competitive pricing across all of the products that are produced, including important for New Zealand, Australia, Canada, and South Africa, that commodity prices remain very, very subdued, even though you might argue in some countries, like the United States, inflationary pressures should be emerging soon. The second theme is tame inflationary pressure, the second outcome. Practically everywhere in the world, there are no inflation worries at all. And this is a surprising development when the United States unemployment is barely 3.5%. Traditionally, with that degree of tightness, we would expect some price pressures to be showing through, but they're not showing through. As far as the United States is concerned, one of the important outcomes of the global situation has been very, very low or negative imported inflation. Prices have been so much under control in the world that when the United States imports, and in general, the US dollar has been relatively strong, we are seeing evidence of imported deflation. An interesting concept is whether that imported deflation into the United States may intensify and threaten the Federal Reserve with a situation of falling prices. Currently, the Federal Reserve is below its target rate of inflation. And if at the margin we were to see evidence of deflation, then the Federal Reserve would move very, very quickly to lower interest rates. And that could be a pretty shocking message for the world and for the United States to be faced with global deflation. C, outcome C. Monetary policies are already very relaxed globally. Some countries, because of the global slowdown in the last 3 months, are already moving towards even more easiness of monetary policy. On the fiscal policy side, it's more of a mixed picture. We know that under the Trump administration, US fiscal policy was eased to the extent we now have $1 trillion fiscal deficit. In other countries, Germany has fairly firm fiscal policy and seems unlikely to ease their fiscal position. Fourth outcome, D. When we look at the world trade picture, it is a very muddy and mixed picture. Sanctions, tariffs, threats of tariffs, non-tariff trade barriers have all made the position of the World Trade Organization more weak, if not completely irrelevant. E, a global slowdown in economic activity, including the United States, is a broad outcome of these themes that I mentioned before. Low inflation, but because of problems in world trade, business confidence has moved lower at a time when we would have expected business confidence to be very high, given the momentum of world trade and the opportunities and low interest rates encouraging business to invest and grow. So these are the 5 outcomes, in my view, of the 4 global themes that I've described. When I look at individual foreign exchange outlooks, I would say the US dollar, at least in the next 6 to 12 months, will continue to attract support and be the major currency of the major currencies. Europe has problems in relation to the slowdown, because although Europe has quietly been putting in place many economic reforms, microeconomic reforms, it is yet to fully benefit from those reforms. The other major is Japan. Japan has continued to struggle in terms of creating a more vibrant internal economy which might match the same vibrancy of its export sector. This is not a new problem. It's a problem they've been struggling with for 20 to 30 years. So in relation to commodity currencies such as New Zealand and Australia, these have been suffering from a view not just of global slowdown, but of further global slowdown, so that commodity prices are likely to be under even more downward pressure than before, making it difficult for Australia and New Zealand to achieve an external surplus or balance, and therefore the markets have downgraded commodity currencies. So that's a broad sketch, and I'll pause the video now and hopefully we can take some questions. Thank you. Bye-bye.